All right, now we're going to get to some fun stuff. If you watched my previous video about merchandising operations, I'm going to expand on that a little bit now and talk about inventory, specifically the different methods that you use to account for how you track the cost of your inventory. It might seem pretty simple until we start diving into this, and some of you might find yourself confused, so bear with me and let's get through this lesson. If you watched my very beginning videos, I talked a little bit about accounting principles, and there are specific accounting principles associated with merchandise inventory. The first one is the consistency principle. Businesses should use the same accounting methods and procedures from one period to the next to keep your information comparable from period to period. The second principle is the disclosure principle, which basically states that companies should report enough information for outsiders to make knowledgeable decisions about the company, and those decisions involve whether or not to lend money to the company or invest into the company. The third one is the materiality concept. Companies must perform strictly proper accounting only for significant material items. It's hard to say. Materiality is anything that could cause an outsider to change their decision about investing or lending. And it's different for different companies based on their size. So when we start talking about what is a material amount or a material misstatement on a financial statement, it involves any amount that would cause the investor to change their mind. So for a big multi-billion-dollar company, a $10,000 error is not considered a material item. It's not enough of an error that would cause an investor to change their mind. But for a small company, a $10,000 error could be a very major, very material amount of money. So it really depends on the size of the company when we start talking about what is material to one company versus another. The fourth principle is the conservatism principle, which basically says that items should be reported accurately, but using a conservative mindset. So what does that mean? That means when you're in doubt, when you're having to estimate numbers, you estimate revenues, gains, the value of your assets at the lowest reasonable amounts, and you estimate any losses, expenses, and liabilities at their highest reasonable amount. That's how you remain conservative. You want to understate the possibility of any revenues and gains or values that you're unsure of, and you want to overstate any expenditures and liabilities and losses so as not to mislead investors or creditors. So when in doubt, always choose the option that undervalues the business. The next concept that you really need to be concerned about when it comes to merchandise inventory is how you exercise control over your merchandise inventory. You want to ensure that inventory is not purchased without proper authorization, that you track and document your orders when they are received, you count the inventory that's received and examine it for damages and make sure you received everything that you ordered and that you paid for. You want to properly record any damaged inventory and either use it, dispose of it, or return it to the seller. You must count your inventory at least once a year and track shrinkage. And shrinkage involves anything that you've lost due to theft, damage, errors, obsolescence, anything you've had to throw away, etc., etc. And then you want to properly record and remove any inventory from your balance sheet, your assets that has been sold. And the value of ending inventory is based on the number of units of inventory you have on hand times whatever the unit cost is for that inventory. And the cost of goods sold is the number of units you've sold times the unit cost. But cost of goods sold also involves the shrinkage that we just discussed. Anything that you have lost due to damage or theft, it also becomes part of your cost of goods sold, even though technically you didn't sell that inventory. It's still a cost you have to capture and record on your income statement, and it's part of calculating that gross profit, whether or not you're making a profit off of the cost of the inventory that you've paid for. Now, when it comes to accounting for inventory, one thing you have to understand is costs do not remain consistent. The unit cost will not be a consistent cost. So what you pay today for a unit is going to be very different than what you will pay tomorrow for that same unit. So the cost that you are going to capture in your system is determined by the cost flow assumption. That's what we're going to be focusing our discussion on today. This is very confusing for accounting students and beginning students. So I'm going to drive home a few concepts that I really want you to capture in relation to the cost flow assumption. This is just an assumption about cost flow. There are 4 cost flow assumptions that a company can choose from when it comes to how they account for the value of inventory and the cost of the inventory that has been sold. The first one is very easy. It is called specific identification. You use specific cost for a unit of inventory that is sold when you know exactly what you sold. And this is best used when we're thinking about something like an automobile that has a VIN number. So you know exactly which vehicle you sold at the time you sold it and exactly how much the cost was of that vehicle for you, so you can capture exactly those specific costs for that unit. The next method that most people are familiar with is called FIFO, F-I-F-O. That stands for first in, first out. This cost flow method is based on using the cost of the oldest inventory as being your cost of goods sold and the cost of the ending inventory that's left on your assets based on the cost you paid for the newest inventory that you purchased. Now, the biggest confusion students get is separating the idea of the actual movement of goods from the movement of the cost of those goods in an accounting system. Those are 2 completely different concepts. And it never fails every week when we start this discussion in the classroom. I always have students that start talking about inventory. Well, if you're selling food, you want to sell that oldest food first before it goes bad and blah, blah, blah. Absolutely, you're correct. But that has nothing to do with the cost flow that we're talking about. It has nothing to do with how you're moving the costs in your accounting system for the inventory that you have sold and the inventory that remains on hand. So the analogy I like to use is, let's say that you own a hardware store and you sell nails. So you have a bucket and you purchase nails and you dump them all into the bucket. And then a week later you buy more nails, but the cost of those nails has gone up. So you pay a different cost for this next batch of nails you buy, but you dump them all in the same bucket. And then another week goes by and you buy yet a third set or a third box of nails, and the price again has gone up, but you take those nails and you dump them all in a bucket. And a customer comes in, gets a handful of those nails and pays you for them. So did the customer buy nails from the first batch you bought that was the cheapest? Or did they buy nails from the second batch that you bought? Or did they buy the most expensive nails? You have no way of knowing, and it doesn't matter. What's going to drive what you enter into your accounting system as your cost of goods sold is going to be based on the cost flow method, the cost flow assumption that you use. If you use first in, first out, you're going to assume you sold those oldest nails first. If you use what we're going to talk about next, last in, first out, which is LIFO, L-I-F-O, you're going to assume you sold the most recent nails that you had purchased to your customer. Again, we're talking about an assumption. We're not talking about actual flow of goods. It doesn't matter what the customer bought. All that matters is the cost flow method you're using to account for it in your accounting system. And I'm going to show you some examples in just a minute. I've just got this blank screen up because I don't want to spoil anything just yet. So the fourth method is the weighted average method, which uses an average cost. So it's going to take the average cost you've paid for all the units you've purchased and base your cost of goods sold and the value of your ending inventory based on that average cost. So in most instances, we live in an environment where costs are rising and not falling. So all the assumptions I'm going to be discussing with you today are based on the idea that prices are rising. So if you compare the effects on the financial statement when you use these different cost flow methods assuming that the costs of inventory are rising, using FIFO, first in, first out, is always going to result in the lowest cost of goods sold and the highest profit. And LIFO, last in, first out, is always going to result in using the highest cost of goods sold and the lowest profit. So some of you, the next question some of you may ask is, well, why would anybody want to do that and reduce their profits? It is a tax savings methodology. So a company that's very successful and is making a lot of money is really going to like using LIFO because it's going to save them money in taxes that they're going to pay. They don't really care about showing the higher profits because they already have plenty of investors and plenty of money. If you're a new up-and-coming business, you may want to use FIFO that's going to show you higher profits because that's going to attract more investors for you. But again, LIFO is a way for companies to get a little bit of break on their taxes. Now, another interesting thing to think about, we've talked about international financial reporting standards and how they differ from U.S. GAAP, and how the United States is trying to converge U.S. GAAP with International Financial Reporting Standards, or IFRS. Well, under IFRS rules, LIFO is not allowed. So when the time comes for the U.S. to actually converge completely with IFRS, we're going to have to do something about LIFO. But LIFO is very popular with companies in the United States. So that's something just to keep in the back of your mind if you're going into the field of accounting, because it's going to become an issue as we progress down this road of converging with International Financial Reporting Standards. So we talked about FIFO showing highest profit, LIFO showing lowest profit. Well, weighted average is going to be somewhere right in the middle between FIFO and LIFO. I'm going to show you an example of this in just a minute. So on your balance sheet, the ending inventory is going to be higher under FIFO because you're going to have those newest higher costs still captured in your ending inventory. And under LIFO, the ending value of your inventory is going to be lower because we're going to have those older costs still on the balance sheet as our inventory values. So LIFO does a much better job of meeting the matching principle guidelines, where we have to match our current activities with our current costs. But FIFO does a much better job of actually valuing the inventory that's on your balance sheet, doing a much better job of what that actual value is. Now, there's one more concept I want to discuss with you before I start showing you some examples, and that is lower of cost or market. It's called the LCM Rule. Now, in most cases, you have to maintain assets on your balance sheet at the historical cost you paid for them. What it cost you at the time you bought that asset is what it stays on your balance sheet at. But when it comes to inventory, you can use lower of cost or market. So what that means is if the market value of the inventory items you are holding has dropped, you can write down, and when I say write down, I mean reduce. You can reduce the value of that inventory on your balance sheet and go ahead and take the loss on that right now. That's what the lower of cost or market rule is. You have to maintain inventory at either its cost or market value if market value is lower, but you can never go above what you actually paid for it. So if the market value of the inventory has gone up, you can't increase the value on the books. You have to maintain it at the original cost that was paid. You can only decrease it, mark it down, if the value has gone down. But once you've marked it down, you can never go back and mark it back up. Not under U.S. GAAP rules. Under International Financial Reporting Standards, you can mark it back up to its cost, but no higher. But under U.S. GAAP, once you've decreased the value on the books, that becomes the new cost basis, and it has to stay there until you sell it. Now, let's get into my examples. So I put on this spreadsheet some examples of a business, and these are the purchases of inventory this business has made and what this inventory has cost them. And I'm using the same scenario for each of the three cost flow methods that we discussed besides specific identification. So if we use FIFO or LIFO or weighted average, this is how this affects the accounting on our books. So these are all the units we bought. We bought 500 units, and these are the varying costs that we paid for the units for a total cost of $762.50. So if we sell 300 units for $3 per unit to our customers, we want to determine what is our cost of goods sold, what is our ending inventory value, and what is our gross profit. Well, if you're using FIFO, remember that's first in, first out. We are going to assume that the 300 units we sold consist of the oldest units first. So we're going to say we sold all 100 of these units that cost us $1. We sold all 150 of these units that cost us $1.50. And then the last 50 units we sold were in this $1.75 category. And you can look at my formula up here. That's exactly what this formula is doing. I sold all of my $1 units, all of my $1.50 units, and only 50 of my $1.75 units. So my total cost of goods sold is $412.50. My ending inventory value, what I'm going to have left in inventory, if I sold 300 units, I have 200 of the 500 I bought that are left in inventory. The 200 units left in my inventory are all going to be based on this $1.75 I paid. So if I take 200 units times $1.75, that's $350. So if I check my math, the total units that I've sold and the total units remaining in my inventory gives me the total that I purchased, and I know my math here is correct. So my total purchases were this, and so between what I sold and what I still have, that's my value. So my revenue, if I sell 300 units for $3 a piece, my revenue is $900. That's not going to change between each of these scenarios. My cost of goods sold is $412.50. There's my gross profit, $487.50. So let's go take a look at what happens under LIFO. So under LIFO, if I'm going to sell 300 units, I'm going to assume the first units I sell are the newer ones I bought. So all 250 of these units I paid $1.75 for, and then 50 of these that I paid $1.50 for. So you see my formula, 250 times $1.75 and plus 50 times $1.50 gives me a total cost of goods sold of $512.50. That's $100 higher than my FIFO cost. So my ending inventory value is going to be, I'm going to say I have all 100 units of the oldest ones, and then 100 units of these $1.50 units are left. That's the 200 units that I have left in my inventory. 100 of those and 100 of those. That gives me ending inventory value of $250. And again, check my math. If my ending inventory plus my sales equals my total purchases, then I know I'm good. So there's my cost of goods sold with my revenue. There's my gross profit. So you see how I'm reporting higher profits under FIFO, lower profits under LIFO, higher cost of goods sold under LIFO, lower cost of goods sold under FIFO. And average cost, as I had said, is going to fall somewhere in between these two, and it does. So if I look at this same scenario, the way you figure your average is, okay, here I have 100 units I paid $1 for. My average cost is $1 per unit. Well, now I have 250 units, and I paid a total of $325 if I add these two together. So that gives me an average cost of $1.30 per unit. So if I take 325 units and divide it, $325 paid and divide it by the 250 units I purchased, that's $1.30 average price per unit. And then the last one, so now I have a total of 500 units, and I paid a total of $762.50. So if I take my $762.50 and divide it by the 500 units I purchased, that gives me a total average cost per unit of $1.53. That's what I'm going to use for both my cost of goods sold and the ending value of my inventory. So if I sell 300 units, multiply it by $1.53 per unit, that's what I'm going to record as cost of goods sold. And if I have 200 units left in inventory times the $1.53 average cost, that gives me $305 as my ending inventory value. And again, I check my math against what I sold, what I still have on hand, should be equal to the total cost I paid, and it is. Then I'll look at my revenue, subtract my cost of goods sold, get my gross profit. That's how you calculate the average cost. Now there's another concept to discuss called phantom profit. If you use first in, first out, you have what is called phantom profit. Well, what is that? Well, let's look back over here at our revenues. We received $900 from our customers. If we have to turn around and purchase more inventory to replace what we sold, when we sold it, we recorded the sales price at this oldest cost, but now we're going to be paying a higher cost. So instead of paying $1 or $1.50 per unit to replace what we sold, it's going to cost us $1.75. So the difference between the cost that I recorded as my cost of goods sold and what it's going to cost me to replace those 300 units that I sold is going to result in what's called phantom profit, because even though the customer gave me $900, I have to and I'm showing a profit of $487.50. It's going to cost me more than the $412 that I recorded as cost of goods sold to replace that inventory. So the difference between my cost of goods sold, if I look at LIFO, it's easy to determine. So if I look at under LIFO, I'm using those newer costs as my cost of goods sold, which would be correct. You can have phantom profit under LIFO, but it's more prevalent under FIFO. So the difference between my cost of goods sold, let's just see here. So if I have 300 units and I got to pay $1.75, it's going to cost me $525 to replace that inventory. So if I look at my cost of goods sold, this minus this, that's $112.50. That is my phantom profit right there, because out of the $900 the customer paid me and the $412.50 that I recorded as cost of goods sold, my gross profit is $487.50, but I'm losing $112.50 of that. Let me put this like this, of that profit, because I've got to turn around and put it right back into my inventory. So my actual profit, add these two together, would only be $375. That's what I get to keep. That's what I get to keep. They give me $900 and it's going to cost me $525 to replace the inventory that I sold. So I'm really only getting to keep $375, but I'm reporting a profit of $487.50. So I hope that makes sense. I know it's a little bit confusing, but if you look at the 300 units times $1.75, if I replace the inventory I've sold, that's where I'm getting the $525 from. So if I take $525 out of the $900 that my customers gave me, it only leaves me $375 in my pocket. So when you hear the word phantom profit, that's what it's referring to. So I will end my lesson here because I know it's been kind of a long one, but I hope getting to see the examples of the FIFO and the LIFO and the weighted average gives you a little better understanding about what these concepts are doing. It's not about the movement of the inventory. It's not about what you're actually selling. It's about how you move the cost you've paid through your accounting system. And the choice to use one or the other is strictly a business decision based on the goals of the business. Do you need to show higher profit, or do you need some tax savings here? So I hope that's helpful. If you're in my classroom and you're confused about anything, let's post some questions and we'll talk about it in the class.